Welcome to the October 2021 monthly market report. We are so happy to have you here to learn about the latest happening in the real estate market and how you can be that trusted advisor, that knowledge broker, that true expert in your market to help better serve your clients. My name is Kate Rezebek, and over the next 20 minutes or so, David Childers and I will be walking you through everything you need to know this month about the housing market. So I'm going to start today with an update on pricing. And I want to begin with this quote from Bill McBride from Calculated Risk. It says, "My sense is the Case-Shiller national annual growth rate of 19.7% is probably close to a peak, and that year-over-year price increases will slow later this year." So what does this mean? As your clients are out there seeing things like prices have peaked, price increases will slow later this year, it sparks questions and uncertainty. And what I'm going to bring for you today is some context and clarity for what's happening with prices and what to expect going forward. So let's start with a look at July 2021 year-over-year home price appreciation. This is the latest data we have, and FHFA is showing that home prices have appreciated by 19.2%. CoreLogic is showing year-over-year appreciation at 18%, and the S&P Case-Shiller Index is showing 19.7%. So this is dramatic. This is incredible home price appreciation. And as we look at this, it is largely due, as we've been saying for months now, to supply and demand. We simply have not had enough homes on the market for the demand from buyers, and that causes prices to rise. So let's take a look at what this looks like across the country. This is our price appreciation map year over year for Q2 of 2021. Now, what you can see here is that the states in red have over 20% appreciation over the past year. As a whole, 17.4% for the United States, but you can really see how it breaks down by state right here. Now, what we're starting to see is the forecast for going forward and what experts are projecting going forward. And that's where I want to really clarify the conversation. And I'm going to start with this quote from Ivy Zelman. It says, "Closings are set to decline roughly 10% year over year in the second half of 2021. And home price appreciation is on the cusp of flipping to a decelerating trend." So what does that mean? I want to hang on that word decelerating for a moment, because that's where we really need to provide the clarity. When consumers see the word decelerating, they're immediately going to think depreciation. But hear me loud and clear when I say that experts are not projecting depreciation. What experts are projecting is increased home price appreciation, just at a slower or more moderate rate. So that's where decelerating comes into the conversation. And it's really mission critical to understand the difference between depreciation and a decelerating trend. So let me show you what that means. This is the estimated home price performance, and it's from the Home Price Expectation Survey. What we can see right here is that through the rest of 2021, home prices are expected to continue to increase at 11.74%. So that means continued appreciation. And what we also see is that's not as massive as what we've seen over the past year with that 18 to 19, almost 20% appreciation. So a more moderate pace through the rest of this year. And going forward, as we look at 2022, 2023, and beyond, we're seeing continued appreciation, but at that more moderate pace, 5.82% for 2022, and so forth. So what that means is that home prices are not expected to decline, they're just expected to appreciate at a slower pace. So let me break that down a little bit further. This is the expected home value change, and this also comes from the Home Price Expectation Survey. So you saw that 11.74% appreciation for 2021. And if we average out the 5 years that I just showed you on the previous slide, the annual average through 2025 is about 5.7%. Now, we know that the historical norm for home price appreciation has been 3.8% per year, but that historical norm has even bumped up to 4.1% due to the price appreciation over the past year. So even the historical norm is climbing. And then cumulatively through 2025, home prices are expected to appreciate 31.8% if we add up the next 5 years. So home prices are definitely still rising, again, due to supply and demand and not expected to decline. And so what's really important is that we help buyers in particular understand that buying now before home prices continue to accelerate is really important. So getting in, well, mortgage rates are still low. We know that mortgage rates are ticking up. We know that home prices are expected to continue to rise. So buying now, if you can find a home, is really mission critical to that long-term wealth advantage. And, we always say, if you could go back 10 years and do it again, would you buy another home? Because the value has increased exponentially. And most people say, yeah, I'd buy a home again, and I'd probably buy 2 or 3. So that's the message we really want to be sharing here, is that home prices are not expected to depreciate. They are just going to be appreciating at a decelerating pace. So now what I'm going to do is I'm going to pass it back over to David, and he's going to talk about what's going to be coming in the fourth quarter.
All right, thanks, Kate, for getting us started today. The other question that a lot of people are asking about right now is, what about the fourth quarter? How is this year going to end up? And normally about this time, we would be bringing on the monthly market report, forecast and things looking forward to the fourth quarter. And it's sort of hard for forecasters to go out and make any type of assumptions on what's going to happen because of the last year and a half in the pandemic and how unusual that's been. So for the next couple of minutes, I'm going to try to explain the position that forecasters are in and show you really what we need to be looking at. And then we're going to wrap up and talk about interest rates, probably one of the biggest issues right now that people are looking at, the rising interest rates, and we'll give you all the information you need to know on that. So let's start off here. Diana Olick from CNBC, she says, fall is usually the start of the slower season for the housing market, but nothing is usual in today's pandemic-driven housing market. Potential home buyers are seeing a slight rise in inventory and consequently rushing back into the fray. Now, I don't know if they're rushing back into the fray, but certainly people are noticing that. Mortgage applications to purchase a home jumped 7% last week from the previous week, and that is the highest level since April of this year. So people saying, hey, we want to get back in. We're seeing rising inventory levels, and forecasters kind of, struggling with how do we forecast the remainder of this year. And the bottom line is home sales are very difficult to forecast right now because of these three lines. What this is annualized home sales from 2019, 2020, and the green line 2021. And what you see there is that 2020 was nothing like a normal year, which we saw in 2019. So if we want to go back to a normal year, we have to go back to 2019 and look and say, okay, what did that look like? Because we know what the pandemic brought. It brought this orange line here on the screen, the dip down, the rise back up, and we sort of did double duty in the second half of last year when we packed all of that business in into a short amount of time after the lockdown. Many people, because of low interest rates, because of the needs of home changing, because of all the things we've talked about on the monthly market report, rushed back into the market, and it became this anomaly year. We sold more homes last year than we've sold before, and we know the story of that. So let me kind of break down why it seems like things are slowing down. And this is probably the best visual I could give you of why that seems that way. Remember the front half of the year, we talked about all the things that we were going to see, from inventory to annualized home sales to, so many things that were going to be up year over year because we were in lockdown. A lot of people took their homes off the market. The business slowed. The economy slowed. Back in the spring of 2020. And then this year, the spring of 2021, we were over that, but simply because things were in lockdown. Well, we're about to enter a time in, the later half of the reporting season, the end of summer into fall and into winter, where we packed a ton of business, and we're going to be below that orange line. And and folks are going to say, hey, we're down year over year, and you're already seeing that happen. We're down in home sales, and foreclosures are rising. Now, we've talked about that issue extensively here, but just realize that's kind of the situation we're heading into. But the reality is we're beating 2019, which was a very, very good year in real estate and the last normal year that we can look at. And you see right where we've, when I isolated 2019 and 2021 here on the screen, you can see right where we're at. And so the reality is we saw 2019 being one of the best years in the last 10 years in real estate, and we're ahead of that right now. This is a look at existing home sales going all the way back to 2012. And you can see it right there. 2019, the best year except for 2017, 1 year was a little bit better in existing home sales, but we're doing very, very good. So if I take things back to where we were just a moment ago, home sales are very, very difficult to forecast because forecasters don't know what's going to happen. Now, in a minute, I'm going to talk about what I believe we really need to be talking about. But the truth right now is they're looking at it going, okay, there are a couple of different options. We're going to kind of come through here and level out or be in the middle of where we were in 2020 and above where we were in 2019. And what you're going to see happen is you're going to see half of the headlines say, hey, we're ahead of where we were in 2019. And the other half, we're going to say, we're down year over year. And there's going to be confusion in that. And this is really the situation that we're in right now, where we packed so much business into the end of last year. We're going to be below that, no doubt. But we're going to be ahead of a very, very normal year in 2019. And that's the quandary that these forecasters are in right now. They don't know what to expect because things have been so unusual for the last couple of years. Now, the one thing that I do think we need to look at, and if you want to know what the future of the real estate market is going to be, we want to look at active listings. And this is a look at active monthly listing counts, 2017, 2018, 2019. Remember I said 2019 was the last normal year we saw. So we went back 3 years. And what typically happens in our business is listings peak sometime in the fall and then drop off, and we repeat the cycle again. You can see here for the last 3 years before we got in the pandemic, 2017, 2018, 2019, listings peaking in the fall and then dropping off before starting over a new year. And then we know after 2019, that brought 2020. Well, in 2020, monthly listing counts peaked in April. So we had listings on the market, they peaked, and then everybody rushed back into the fray, and we started to dwindle listings all across the country. Now this sets up the challenge moving forward. Has always been closing the gap. As those listings dropped, sales shot up. Remember how we just looked at that graphic? So listings are going down, sales are shooting up. And the big question becomes now, when will listings peak this year? And so if we saw listings drop last year and we kind of troughed out here in the front part of the year, less listings on the market than what we've ever seen. The question is now, when will they peak? And there are sort of three scenarios. One is they're going to continue to grow and we're going to kind of eclipse where we were in 2020, and that's going to give us a little bit of relief in the frenzy in the market and pricing relief. There's kind of a second option that just flattens out and, we kind of continue on there and probably intersect where we were in 2020 at some point. And then there's the third option where listings peak and begin to dwindle. Now, if the third option happens, that's where you see more price appreciation, it's upward pressure on prices, and that will be the story. But I think there are three reasons why we will see continued listings going into this fall. First of all, pent-up seller demand. No doubt homeowners are going to be more comfortable putting their homes in the market as more people get vaccinated. They feel comfortable from a health perspective doing so. Number two, new construction is starting to take off. Builders are realizing the opportunity, trying to build as much as they can. Now, this past year, they've had a lot of headwinds in front of them with material costs, specifically lumber, all the things they need to build a home outside of lumber. all the labor costs and labor shortages have been a headwind for builders, but they're starting to turn the corner and build and see the opportunity in this market. And three, the end of forbearance will create new listings. Now, we've gone over this extensively on the monthly market reports. It's not going to create this wave of foreclosures, but it will create a time in the market for people that say, you know what, we can't afford the home any longer. We're going to have to put the house on the market. So I think there are a lot of reasons right now that we'll see that listing number begin to or continue to climb. But at the end of the day, we're going to have to watch. If we really want to know what's going to happen in this question of what's the market going to do, we have to watch listings, and we have to be diligent about getting out there and obtaining those listings. And, I've talked all the time about, what Kate even started off here, the pricing, byproduct today is increased equity in so many people's homes. And they're saying, you know what, we may take advantage of that equity and move and upsize, downsize, whatever the case may be for them and their family. And that's really the situation that we're in relative to forecasting the fourth quarter and going into next year. It will be all about listings. Now, the other big story right now is interest rates. No doubt, we're starting to see some movement in interest rates for a lot of different reasons. But I want to talk about that for just a minute. And certainly not here today to say the sky is falling and interest rates are about to shoot up, but want to give you a look at what interest rates are doing so that you can be educated on this topic. First quote here from Ali Wolf: the single biggest risk to housing is rising mortgage rates. There's a real possibility the next year and could bring prices down. Further economic, financial, and confidence challenges could also result in a drop or flattening of home prices. But a drop or flattening in home prices is a far cry from the crash we saw during the Great Recession. So Ali Wolf saying, you know what, the biggest issue, the frenzy in the housing market could be rising interest rates. It's going to be more expensive for people to borrow. Right now, the 30-year fix just jumped above 3%. It's sort of crazy that we're talking about a rising interest rate environment, and we're at an average 30-year fixed of just over 3%. You see right here, 3.01% as recorded by Freddie Mac on their weekly survey. And that jumped up as they're starting to see, indications of the Fed saying we're going to taper soon. The word they've used is soon right now. Sam Cater from Freddie Mac says this: many factors led to this increase, including the Federal Reserve communicating that it will taper its support of the capital markets. Time out there. That's the soon element. The Fed came out and said, we've been buying mortgage-backed securities. Now we're going to start to taper that. We're going to start to pull back on that, and we'll do that coming up. The market's starting to price that in. It goes on to say the broadening of inflation and emerging energy supply shortages, which compound other material and labor shortages. So the issue right here is the economy is recovering, not recovering as quickly as what they would like to see, but the Fed's saying, hey, we're going to start to taper on what we're buying in the mortgage market. So that's causing interest rates to go up. Now, I think it's important that we realize we're in a great environment right now. It will cost more to buy as homes appreciate going into the next year, as interest rates rise going into the next year, but nobody's calling for this sharp spike up in rates. Matter of fact, here are the latest projections in interest rates from Fannie, Freddie, MBA, and NAR. And you can see somewhere around the middle to the third quarter of next year being around 3.5%. So we're just right at about 3% right now, 3.5%. If we want a visual for this, we've got the Freddie Mac visual right here. You see the drop in rates through the pandemic and starting to inch back up. Freddie Mac saying by the third quarter being around 3.7%. I don't know. I'm not here today to say this is where interest rates are going to be. I don't think it's going to be at 4% and probably not at 3.25%, somewhere in the middle there. Call it 3.5%, maybe a little bit more than that. But no doubt interest rates are going to rise. Now, if you go into the member area into infographics, we have a slide that you can use, and you can put your price point in there to demonstrate the cost of waiting. In this example here, I've got a $400,000 loan that somebody may obtain to buy a home. And, if they look at 2 3/4, which we've been at for quite a while, that payment's about $1,633 there. If you go up to 3%, it's $1,686 right above that. Well, if interest rates go up in the next year, knocking on 4%, that rate now allows you to buy a lot less home. And we don't want to convince anybody to do anything they don't want to do, but we want to show them that as prices rise, as rates rise, it's going to cost more in the long run to buy a home and certainly to finance that home. So that will equip you again. That's in the infographics section of your member area. You can download that. You can adjust it for your price point and use that as you're having these types of conversations. As I wrap up the monthly market report, a couple of things I want to mention. One, DS News came out with this quote, thought it was very, very good. Homeownership is one of the fundamental keys to accumulating wealth in America, hence why it has been integrally linked to achieving the American dream. Not only can owning a home provide a roof over your head and a secure place to live, but because mortgage payments generally remain fixed while rents may rise over time, a home can be a very effective hedge against inflation. Inflation's being talked a lot about right now. A home is a very effective hedge against inflation because you have a fixed payment. It goes on to say, together, these features can give homeowners an enormous advantage over renters when it comes to accumulating wealth. The opportunity for home ownership, not only is it shelter, we know the financial, non-financial benefits of home ownership, but it helps people build wealth, no doubt, all across this country. The question right now with rising interest rates, prices going up, many people saying, I don't want to buy right now because I don't want to buy at the top of the market. Well, I have this conversation just like you do with friends, and you're certainly having it with clients more and more these days. But what people fail to miss in that is forecasters are not calling for depreciation in the market. I think there may be some deceleration of prices, meaning we're not going to stay at the price point that the appreciation point that we've been at, and we're going to see less appreciation, but not depreciation. The home price expectation survey just came out. If you look at a $350,000 home over the next 5 years, the purchaser of that home stands to gain just over $111,000 in gained equity based on forecast appreciations for the next 5 years. And when people see this, that are thinking that, why would I buy at the top of the market? They miss this piece and they go, wow. But right now, the bottom line is homes across this country are underbuilt. We've talked about that, undersupplied, and that's not going to be fixed overnight. So I hope all this information finds you well. One thing I do want to call your attention to in the member area, the Latino community e-guide, the agent's guide to working with Latino community. You want to go check that out. Right now, we're in Hispanic Heritage Month, September 15th to October 15th. This e-guide is available, 16 pages, something you can use, current data, current insights on the Latino market. I hope you'll go in and take advantage of that. As always, the monthly market report is intended to give you everything you need to know, the insights, the data, and all of the information that you need at your fingertips so that you can be the educated agent in the market. So we're grateful for your support, all the time that you invest in listening to the monthly market report, and we'll see you back again this time next month. Take care. Bye-bye.